Okay, noobs, I know you want to know. How much can you make if you start doing your own commercial real estate development deals? If you've climbed the real estate development ladder, have the contacts to originate and fund deals, and the transaction and execution experience, you might consider starting your own development firm. Is it worth giving up your cushy salary to take the leap? There's this flawed stereotype that we're all unethical, greedy millionaires, and it's just not true. Some of us are billionaires. There's a pretty standard framework on how we make money, and if you understand it well, it can help you determine if it makes sense to go on your own or stick to your job and save up more money. I'll go over the revenue sources, which are basically fees and deal profits, then break down typical expenses, and whatever's left over is profit. As a developer, you are the GP, or the sponsor of a deal, and the fees are your compensation for doing all the work associated with originating and managing the deals while your LPs sit back and get progress reports. There are 4 market standard fees that developers can reasonably charge on deals. I say market standard because developers and investors alike will be familiar with these terms, but they can be negotiated. If you try to fundraise with non-standard fee structures and mechanisms, you'll probably get some pushback and have to deal with higher legal costs for customizing terms. So if you're just getting started, don't stray too far away from the standards. Anyway, the first fee is an acquisition fee, paid upon closing and ranging from 0.5 to 2%. This is meant to cover all your work your team puts into sourcing, underwriting, and assembling the contractors for a deal. And this can add up to a lot of work because you may look at over 100 deals just to successfully close on one. Generally, the larger the deal is, the smaller the fee percentage, because if you close on a $5 million property, a 2% fee will be $100,000, which may barely cover your labor costs to put a deal together. But if you do a $100 million acquisition, investors might push back on why the sourcing work costs $2 million and haggle it down. Once construction starts, development fees kick in, ranging from 3 to 5% of the construction budget. So if your construction budget is $500,000, 5% is probably not even worth your team's time to manage it. But if you got a $50 million construction budget, well, 3% is $1.5 million. These fees cover all the management work you take on during the construction period, like coordinating vendors, maintaining schedules and budgets, and reporting. It's usually split up and paid at milestones throughout the project to make sure you're hitting your targets. If you offer certain services in-house, like architecture and design, you can get separate fees for that. Once you're done with a project, the business plan is usually to exit as soon as possible to maximize your IRRs, but in some cases you hang on to it. At that point, you can start charging asset management fees, which can be 2% of equity, or 2% of gross revenue, or sometimes 2% of assets under management. It depends on how much work is required, because you could be doing full-on property management, or simply administering the ownership entity until the eventual sale, which is when you can charge disposition fees, which range from 0.5 to 2% of gross proceeds, again depending on the size of the deal. Bigger deals get smaller percentages. This is for all the marketing and legal work done throughout the sale process alongside a broker who gets paid their 3% commission as well. So to recap fees, let's walk through how much the high end of the fees are on a $10 million deal with a $5 million acquisition, $4 million construction, leaving room for $1 million in financing costs, a 3-year construction timeline, and a 1-year hold before disposition. You'll earn a $100K acquisition fee and a $200K development fee. If total equity is 35%, or $3.5 million, you earn $70,000 in the 1-year hold period after completion. Assuming a $13 million exit and a 2% disposition fee, you get $260,000 at the end. So grand total over 4 years, $630,000. But on the low end of all the fees, you would earn less than half of that amount. Are you sufficiently underwhelmed? But of course, after disposition, you get a share of the profits based on the amount of equity you put in and the promote structure. Deal profits can really be all over the place. Some developers have achieved ridiculously high equity multiples in a short time period by being in the right asset class at the right time in a changing neighborhood. And some have good enough track records where they can negotiate not putting in any equity, while others have lost everything and gone bankrupt. But if you're just starting out, you're probably not going to convince investors to do anything too risky that will lead you to extreme outcomes, meaning your cap stack and waterfall structures will be fairly standard. If you don't know what those are, you're not ready to become a developer, and you should watch this video and the one right after it. They cover market standard promote structures. I'll also be making some videos on variations of these structures, and if they're out by the time you're watching them, then the link is up here. Generally, as the GP investor, you put in the least amount of money and you pay yourself out the highest returns, but only if you deliver on the minimum return hurdle you promised, and you're the last one to get paid out. LP investors see deals targeting 15 to 20% IRRs all day long, which usually means the GPs will achieve 20 to 30% IRRs if they hit the exit targets on schedule. Now, going back to the $10 million example with a $13 million exit and $3.5 million in equity, if you put in the market standard 10% of the equity, which in this case is $350,000, and you get a 25% IRR over 4 years, you get back around $850,000. So you profit about $500,000 in the 4-year period. So altogether on this project, you'll have earned up to $630,000 in fees and an extra $500,000 in profits for a total of $1.1 million over 4 years. You may have noticed that this isn't spread evenly over the 4 years. Most of it comes at the end, which will make you wonder as you're slurping on ramen, why did you leave your job? And then your employees will smack you and tell you to stop daydreaming because you gotta make payroll. Oh yeah. Expenses. Most of the expenses are labor. You could try doing everything yourself, but you're going to be spread too thin and you won't get very far. A partner is ideal, but you'll need to split the profits with them. And you'll also probably need one acquisitions analyst to start and a project manager once you get your first deal going. I shed some light on salaries in this video. If you want to hire junior people to start, you'll pay under $100,000 each, but you'll also have to spend a lot of time training them and you'll be responsible for the heavy lifting. If you want more senior people and fewer headaches so you can focus on growing the business, you're going to be paying 6-figure salaries. Benefits and payroll taxes will add another 20% or so to the salaries. Aside from labor, you've got to cover rent, IT costs like computers and software, and admin expenses. These overheads scale with your staff and also depend on your location. If you're in New York, office rent will be a few thousand a month for just 2 or 3 people. Total operating expenses for a bare bones team in an office could easily exceed $250,000 a year. Wait, but in that $10 million deal example, the revenues average out to just over $250,000 a year, but most of it came in year 4. You might be getting the sense by now that if you've only got one $10 million deal and a couple employees, you're losing money. Setting up a development firm doesn't make any financial sense if you're only going to do one deal at a time, especially if you can only handle relatively small deals. But there is an inflection point where things turn profitable, because between yourself, a partner, an acquisitions analyst, and a PM, your team should be able to handle 3 to 5 deals simultaneously. So go back and review those fee and promote earnings and multiply them by 5. Year 4 will probably be a pretty sweet year for you. There is one more assumption I made that you shouldn't overlook though. It's that everything goes to plan and you exit on time. Every deal has its own risk, and there's always a chance you don't hit your targets and then end up losing money on the exit side, putting you in a pretty uncomfortable position to cover expenses. So doing multiple deals not only gets you to profitability, but it should also spread your GP investment out, thereby lowering your exposure to risk. If you're really unlucky and all your deals are hit by macro factors, you could lose everything. But if you manage your risk well and you find good deals, in general, you'll end up making more by taking on bigger deals and putting more money in. So as a developer, your long-term goal is to maximize 2 things: the total project budget of your deals that investors trust you with, and the amount of cash you have to invest as a GP. Which led me to the question, what was the optimal amount of capital that I should have started with so I wasn't bootstrapping so hard? I went pretty deep down an analysis rabbit hole, and it expanded this video into a 2-parter. And the answer actually made me pretty sad, so I moped around for 2 weeks procrastinating on this video. But the next video is coming out next week, so hit that subscribe button and stay curious, noobs. Oh, and one more thing. Follow me on LinkedIn too. The link to my profile is in the description. I'm going to be doing some more written content on there.